On the Spot with Michelle McCory is brought to you by Prime XBT.
I'm Michelle McCory. Thank you for joining us. The Nasdaq has recorded its best first half of the year since 1983. That's the best start in 4 decades. It's gained about 32% for the first 6 months of 2023. Now, the S&P 500 is up 16% over the same time. Equity markets have pushed higher even with an aggressive Fed, turmoil in the regional banking sector, and all that brinkmanship over the government debt ceiling. Well, my next guest says that this is just part of the crack-up boom and that he does expect markets to continue to rally. Florian Grumes is the managing director of Midas Touch Consulting and has almost 3 decades of experience in the financial markets and is also a fan favorite here on Kitco. Welcome back, Florian.
Thank you, Michelle. Thanks for having me again.
Great to have you. And Florian, of course, we want to get your forecasts for gold and for Bitcoin. But let's first break down this crack up boom theory that you're saying, because you're saying that the strong start to 2023 is indeed the crack up boom playing out. Explain what you mean by that.
Well, I would say at least partially it's the crack up boom that's playing out. Initially, remember last year, September, October, after the massive bear market in nearly everything last year, the markets were deeply oversold. Sentiment was extremely pessimistic. Everybody was trying to hedge or to short the markets. And that was basically the ideal setup for a bottom and a bounce or a recovery rally. And I think that happened not only in the stock market, but also in precious metals, in selected commodities, and Bitcoin then a little bit later. And that went on until early spring, when you suddenly saw a bank run in America and 3 larger banks going belly up, basically. And the Federal Reserve just over 1 weekend basically came back with a sort of quantitative easing light, you can call it, and they basically pumped 400 billion into the markets. And that is, I think, the justification why I come up with the term of the cracker boom once again, because since then you've seen the markets marching higher while everybody was rather afraid and thinking that we should see another crash given the high interest rate environment, yet markets continue to move higher.
All right, well, let's look at the term crack up boom a little more closely here, especially for our viewers that are not familiar with it. It was coined by Ludwig von Mises, a noted member of the Austrian School of Economics. And according to Investopedia here, Florian, a crack up boom is the crash of the credit and monetary system due to continual credit expansion and price increases that cannot be sustained long term. In the face of excessive credit expansion, consumers' inflation expectations accelerate to the point that money becomes worthless and the economic system crashes. Okay, now I get that there is a flight away from cash as there are concerns about inflation and there's concerns about currency debasement and devaluation. But do you see the crack up boom playing out in the way that it's been defined here? Do you see the economic system crashing as is the next stage of a crack up boom and the dollar essentially becoming worthless?
I think you have to understand that this happens in stages, right? And we're certainly not in the final chapter of a crack up boom. But you can see that people have lost already significant amount of confidence into the currency systems, not only the dollar, but also the euro and others. And at the same time, you can also see that we're now facing inflation that is rather sticky. You've been seeing that labor has become rather difficult to get. And I think that it's a process. And I think that given the massive injections, and without that, I mean, the system would have been long imploded, right? So we've been there very close last March, and that is the main reason they continue to pump money into the markets in the end of the day. Of course, you can have a lengthy discussion what exactly they're doing. You can come up with lots of special terms, etc., etc. But in the end of the day, they have been printing money, and that's what basically has pushed the markets higher. That's what continues to push you and me away from keeping money in the bank account and trying to invest it wherever you can. because you know that you're losing purchasing power.
All right, well, they have been printing money, but we have seen a very hawkish Federal Reserve raising rates and also implementing some quantitative tightening. So I want to go back to this idea of, if you do ultimately see the economic system crashing, I get that this takes time, I get that this is a cycle, I get that this doesn't happen overnight, but the term crack up a boom has been applied to what we saw in the economies of Zimbabwe, China, Argentina, and Brazil. Do you see that really happening in the US? Do you really see the money flowing in right now because there is lack of faith in the efficacy of the dollar, and then it ultimately bringing the whole system to a collapse?
Yeah, I mean, that's the final outcome or in any fiat money system. Remember that since the end of the gold standard in 1971, this currency system is backed by nothing than the faith of the people and the force of the state. And now it takes much more than the last time to rescue the system. As I just explained, over the weekend, they decided 400 billion in rescue packages very quickly. And the next time they will have to come up with even more, because this is a fiat system backed by nothing. And it will repeat itself again and again and again. The only question is how long it takes. And of course, the dollar is a very big and the most established currency system over the last 50 to 80 years. So it might take much longer than in a small country like Venezuela or Zimbabwe. But in the end of the day, it all depends on psychology. And it's just a question of perception. And as you've realized over the last few months, the de-dollarization topic popped up rather violently, and lots of people discussed it. Yeah. And I think it's obvious that we have a break between the East and the West. There's a new Cold War already going on. And the BRICS countries trying to move away from the dollar. And I think things are accelerating, but it's a process that might take the next 10 years.
Right. And that is a pretty consistent view that we've had amongst many guests on this show, Florian, that we do have the bifurcation of the global monetary system, and that this will ultimately lead to a massive decline in the dollar's dominance as a global reserve currency, and could ultimately see the economic system that we know come to a collapse, and not before a 10-year time period. So does this crack up a boom then sustain until that part, or surely you see this as just sort of one ebb and flow in a bigger market cycle?
It's certainly,
and by that I mean the fact that we've got money flooding into markets now. If this thing takes about 10 years to play out, then this rally that we're seeing in the markets, I'm assuming, is not going to be sustained for that period of time. What is your projection of how long this current rally lasts?
Well, I mean, right now, obviously, we are in a seasonally a little bit challenging period the next 2-3 months. Usually the stock market can have some problems towards and into September. And we have a very sharp rally over the last few months, so I wouldn't be surprised to see some weaknesses and pullbacks. It's certainly not a good time to step into the stock market right now. However, I think once we have the slightest problems in the market again, you will see the Fed being forced to come up with the next rescue package rather very quickly. So I don't think that we're going to see a longer kind of like correction or bear market like that could last another 1, 2, 3 years. It could be a matter of a few weeks, maybe 1, 2, 3 months, pullbacks, yes, but not something much longer, because it will actually risk that the system is completely imploding, and the Fed will not be willing to accept that.
Well, the expectations right now is for the Fed to hike at the next meeting, and Fed Chair Jerome Powell is signaling that we should expect at least 2 more rate hikes this year. That's consistent with what we saw in the so-called dot plot. What do you expect from the Fed then with regards to the next couple of rate hikes?
I think that they have stopped. If they would break another 1 or 2 times, okay. I don't think it makes a big difference, because we're already at 5% and higher. So the large chunk of it has been done. I personally think they have stopped already. And I think that rather sooner than later, probably, let's say, towards end of the third, fourth quarter, they will be forced to cut rates again. But
you see a pivot by the end of the fourth quarter, is what you said?
Yeah, I think so. That's most likely. I think that we're going to see, and that's, by the way, part of the cracker boom, right? I mean, this is a beautiful way to explain that on the one hand, you have rising stock markets while the real activity or the activity in the real economy is actually not really that good like you would think if you look at the stock market. So you're going to see more and more problems cracking up in the real economy over the next few months, I guess. And at some point, then the Fed will be forced to lower rates again.
And you're expecting a pivot by the end of this year, by the end of the fourth quarter?
Probably end of this year, latest by early next year. I mean, I've been a little bit wrong in my timing so far with the pivots, but it's not like, I mean, I'm a trader and an investor. Right. I need to be in the market and not like forecast what the Fed is doing.
Okay. I mean, I get that predicting exact timelines can be very challenging, and I always applaud the guests that are willing to give me a specific timeline on this show. We've already seen the damage of these aggressive rate hikes, certainly in the regional banking sector. And you recently wrote in one of your reports that what we're starting to see is a tremendous amount of bankruptcy filings. In fact, you said that bankruptcy filings in the US this year have reached the highest level since 2010. Is that across a range of businesses and sectors? Where are we seeing this, Florian?
It's quite a bit of a range or different sectors, different types of businesses. Obviously, there's also the big banks that have been failing in March, but it's also Vice Media, if you remember, they went bust. And overall, it's this number has doubled in compared to the same period of last year, and it's the highest number of fillings since 2010. So there is something brewing which you don't really see in the news, and which also is not shown by the stock market data. By the way, I mean, one thing we also have to mention about the rally in the stock market, it's not a very broad rally, right? It's focused on a few selected stocks and on the AI boom. Most of the other stocks have gone nowhere or lower. So it's not a very healthy market in general.
Yeah, very concentrated in some of the big tech names. So it's interesting that if we have all of these bankruptcy filings coming in at some point, surely that starts to get reflected in the markets. I'm assuming that these are smaller businesses, not publicly listed companies. Otherwise, we'd be seeing more of that. I'm assuming that these are smaller companies that are filing for bankruptcies.
Oh, there are some multi-billion-dollar companies, definitely. And I mean, as I said, those three banks, they were definitely big banks.
Yeah. Those count.
I think it's to be taken serious. And remember, I mean, real estate, which is the commercial real estate sector that I'm talking about, this is all moving a little bit slower than your crypto markets, right?
Right.
These things take a little bit longer to play out. And I think that we're going to see more and more stress in the commercial real estate sector. And remember, I mean, 2008, the last big financial crisis, I mean, the Fed stopped hiking rates in 2006, in the summer of 2006. And then still the markets kept marching higher, and it took a year and a half, I think, until they really started to roll over. So we could be in a similar situation. The only thing that I think is different this time that the Fed will not accept and watch basically a year-long correction unfolding. I think they will be forced to step in much earlier and much quicker than they did back in 2008.
Okay, to step in and pivot and cut those rates earlier than expected. Of course, that begs the question, what does that mean for inflation? The Fed has claimed a mild victory with inflation. It's been cooling slightly, at least according to the government data that we're seeing, the Fed's preferred inflation measure, the PCE reading, that came in at the lowest level in 2 years. The personal consumption expenditures index, that eased to 3.8% year over year in May, a drop from 4.3 the month before. So a slight cooling there. You're saying not to make too much of a deal about this, that this is probably just a temporary effect if the Fed is then forced to pivot.
I think that the Fed is now meeting the rather stickier part of the inflation topic. They've been definitely successful in bringing it down from those very high levels. But then again, I think that one of the big part is obviously oil prices. Saudi needs a higher oil price. Russia needs a higher oil price. And I don't see how they will be able to push oil much lower from here. So I think they're going to meet the sticky part of inflation now, and this can quickly turn around again as well if we have more geopolitical escalation. I mean, there's a lot of topics on the table that can escalate anytime, any day.
Right.
So I don't think that inflation is going much lower from here. I rather think that it will be sticky and at some point turn around once they start pivoting, and then we'll have to print the next round of money.
Okay, so Florian, big picture, gold should really be doing much better, especially if we are going to see this crack up a boom and collapse of the system that you're forecasting. Now, we did see gold rally a little bit when we had those big bank failures earlier this year, but gold has pulled back as we've seen the Fed tighten, and gold is now at around the 1920 per ounce level. So what is your outlook for gold?
Right. I think it's very important for the viewers to understand where we are in the gold market right now. So I have brought some charts for you to give you a better understanding. I think I keep it very basic and simple, but I think it's important to understand where we are. And I want to zoom out to start with and look at the last 52 years in the gold market. So that's a monthly chart. And down here in the left corner, the blue arrow, basically, that's the end of the gold standard when Nixon, nearly to the day in 1 month and 52 years ago, he ended the gold standard. And since then, we are in a fiat money system backed by nothing than faith and the force of the state and the promises of bureaucrats and central bankers and politicians, not to forget. So gold started in the early 1970s or late 1960s at $35 an ounce. And it went, after the end of the gold standard, it went very violently and quickly within 10 years, up to a top of $890, a gain of nearly 2,500% back then in the 1970s. So that's the inflationary roaring disco 1970s that many people refer when they talk about inflation. And what followed when the top was in January 1981, it followed a 20-year bear market in gold, which basically shook off any gold bug. It was a terrible time. Of course, you had some rallies in between, but overall, gold went down for 20 years. And it only ended at $250 an ounce in 1999. And then you had this famous double bottom, the famous Gordon Brown double bottom, when the British finance minister managed to sell the British gold reserves right at the low of a 20-year bear market. And from there, gold took off. And that's basically when I started investing in gold. That's when I bought my first Kruger around 22 years ago.
Good timing.
And, yeah, I didn't know. I had no clue that this was like a double bottom, but I remembered what my grandfather had told me. And intuitively, somehow, I started focusing on the gold market without knowing that this was actually the perfect timing after a 20-year bear market. And gold went up massively from 2001 until 2011. 10-year bull market, it went up 670%. And so you can see that it's not what they tell you nowadays, that gold is going nowhere. I mean, gold can make big moves and has done so in the past. Of course, and that is a very important top here, the red arrow. This is the top in 2011. This is now 12 years ago, 1920, and that's exactly where we are trading right now. That's been the top in 2011 after a 10-year bull market. And if something goes up so steeply, it has to recover, it has to digest, it has to consolidate. And that's what happened. And gold went down nearly 45% over the following four and a half years, only to reach a bottom here at 1,045 in December 2015. So this is 7 years ago. That was your last best buying opportunity in the gold market. And since then, gold recovered and has reached again a new all-time high, 2070. This is 3 years ago. And as you can see, it's been running against this 2070 dollar mark, resistance mark now for the third time, just recently in early May this year. So this is just 2 months ago. Gold reached $2,070 again, and it failed. It came back down, and that's exactly the correction that happened that you just described, and that took gold back down to 1920. So this is the very big picture. I believe that since 2011, over the last 12 years, gold is in some form of a consolidation pattern. And if we're going to zoom in a little bit further, and that's the weekly chart, so you're going to have the top in 2011 here on the left side at $1,920. We have the low at $1,045. This was December 2015. And you have the top in summer of 2020, a few months after the Corona crash happened and the central banks flooded the market with money. Gold went up to $2,075, reaching a new all-time high. And since then, again, it's correcting and consolidating. We had another run during the Russian invasion. It went to 2070, and then last year we had this steep pullback when the central banks started raising rates in America. And now just recently gold is back up at this 2070 resistance. So what I want to tell you on this chart, we are most likely seeing a so-called cup and handle formation. And all it takes for gold is to break through this $2,070 level. I think that's what really is the most important question for gold. When will this happen? Will it happen now in the next few months, or will it take maybe another half a year or a year of consolidation? But overall, that's, I believe, what's going to happen and what will catapult gold much higher in the mid to the longer term, let's say over the next 2 to 3 years. Because once you break out of this resistance level, sky is the limit. I think $2,500 will be seen very quickly. And then over the following 2 or 3 years, we could easily go to $3,500, $5,000. It's all possible because this formation here has been 12 years in the making. There's been a lot of energy being compressed. And as you can see also on the left side, the top from 2011 is more or less in the same region where we have this resistance now at 2070. So I think it's a very big consolidation pattern in the gold market that is about to end, and it could end now in the next 2 or 3 months. Maybe it takes another round of consolidation. Maybe gold wants to really shake off all the weak hands in the next few weeks, and maybe with goes 1 or 2 levels lower, maybe 1850. I don't think it will go much lower than 1800. That's really my worst case nowadays. But that's the big picture in gold. So you need to be. And that, I think that's really important to understand.
Okay, so gold is in a 12-year consolidation period here, Florian, and you're saying that once it breaks that 2070 mark, that resistance, that all-time high, you said sky is the limit, but clearly not the sky is the limit. If it does break the all-time high, and many were expecting gold to break all-time highs going into 2023, what would be your forecast as the next move up after breaking the all-time high?
I think if we can clear this resistance level, it will take probably a rally of 2 to 3, 4, maximum 5 months, and it will take gold to 2,525. I think that's the minimum target, and most likely we will get a pullback then and testing this breakout zone. So don't be surprised if gold comes back testing this former resistance, which will then have become support. But I think after that, gold is off to races, and I think we're going to see $3,000, $4,000, $5,000 in the next few years. Very likely.
$3,000, $4,000, $5,000 gold over what time period, roughly?
Yeah, in the next 2 to 3 years, I think that's very likely.
So $5,000 gold in the next 3 years. I'm going to take the long range of the long end of both of those ranges.
Yes. Okay. Let's go for that number.
Okay. $5,000 gold.
Like the exact price target out of this cup and handle pattern, I think, is 3,575.
Okay.
And the exact price target of this little handle on the right side is 2,500 and something. So these are the first two targets. But then I think, as we know, that once the gold train is underway and there is a kind of a gold rush, there is like it's a mass psychological phenomenon, and it can go much higher actually.
Right. Okay, but yet in the near term, gold has failed to perform as many would think it should, particularly on the back of that very aggressive Fed. Gold has been holding at around, as we said, 1920, and there's concern that if gold drops below that 1900 per ounce level, that then we're going to see a huge sell-off. But you're saying you don't agree with that?
No, I don't see a huge sell-off.
Even if we drop past below 1900?
Yeah, look, this is the daily chart that I brought here as well. And you can see the red line is the 200-day moving average. It's nothing. It's just basic technical analysis, of course, but it's an important moving average. Gold has been firmly trading above that moving average for now, I think, 8 months. And this would be the worst case, actually testing this moving average, which actually is moving higher. So it tells you are in an uptrend. I don't think that gold can crash lower at the moment. I mean, again, okay, 1850, 1875, that could be another potential price target zone, but I don't see it much lower from there. And in fact, last Thursday, we had a reversal already in the gold market. It went to exactly the 38.2 Fibonacci retracement of the whole rally since November. And it turned around violently last Thursday from 1893, and it's trading nearly $30 higher at the moment as we speak. And the gold miners, GDX, had a beautiful big weekly reversal candle. So I think there's more and more puzzles falling into place that basically telling us that probably this correction, which I actually called in early May, here at 2070, this whole move over the last 2 months is coming to an end. And I think the downside is very limited, and that was the point why I want to show you the charts. I think the upside is phenomenal. You're probably looking at a $50 risk to the downside, maybe remaining risk to the downside, while from here 1920, gold could rally $600 over the next 6 to 8 months, easily.
Okay, before we get into the gold miners, so just to be clear here, you are saying that you're comfortable calling a bottom for gold in this broader cycle at 1850? You just do not see gold dropping below 1850 in this broader cycle?
Yeah, exactly. I don't think it's going lower than that. And in fact, let me just quickly go to that chart. This is the seasonality. So there is a seasonal pattern over the last 54 years in gold established. And you can see that here, the green arrow, this is like nearly where we are right now. This is early July. That's where the seasonality, statistically speaking, turns around and usually brings you a massive rally over the following 3 to 4 months. Usually gold around this late June, early July, maybe by mid-July, finds an important low of the year and then stages a massive rally into August, September, and sometimes even into October. So that's the classical seasonal pattern for gold, which also would argue that we've either seen the low last Thursday or going to see it within the next 2 to 3 weeks.
So what would be the trigger to get gold to really catapult above that all-time high, Florian? Would that be the Fed pivoting and cutting?
Yeah, it could be that gold starts to price in that kind of move. I think there's also a lot of technical buying. There is a lot of, markets in the end of the day are perception, right? And if more and more people think the same way and see that opportunity, realizing that gold is about to break out of a 12-year consolidation pattern, I think it's a perception, first of all, and psychology. The technicals are still positive. It could be that gold early on starts to price in a Fed pivot at some point, yes. The markets are looking ahead 6 to 8 months, right? So that could be, that will tell us that if gold starts to rally strongly by August, September, will tell us that probably latest by first quarter of next year, there will be a pivot, yes.
Okay. Do you see gold as a, I guess, leading indicator towards a pivot? Do you, in a psychological point of view, do you see that if gold starts to rally, then it means that the expectations for a pivot are increasing?
Yeah, I think you're making a very important point here. I think that gold is smart money, right? And there's a lot of smart people investing in gold, and they constantly anticipating the next moves and the next geopolitical outcomes and the next moves of the Fed as well, of course. And gold has been, gold is in a correction since 3 years already, while stock market and Bitcoin topped out 1.5 years ago. So gold is actually a step ahead. And it also bottomed out much more clearly in last early November. And since then, also the rally initially was much stronger than in the stock market. So yes, I think that gold will be the first one to price in such changes. Yes.
Okay. All right. Let's talk about the miners then, because you have said that gold mining stocks have been underperforming. If we look at the GDX index, it's only up 3.5%, so underperforming the overall market. What is your call there? Is this an opportunity then?
I think that many of the mining stocks have been beaten down way too much. They were not able to follow the gold price over the last 8 months, so to speak. I think many of them have a lot of potential to catch up once we get the breakout. Of course, you have hundreds, if not thousands, of different mining stocks, and it's very difficult to pick the right ones. But I think a few are very promising, and many of them are undervalued right now. And you will get a completely new or revaluation of the sector once gold is starting to clearly break out.
Do you have any picks?
Yes, I mean, of course, you start with the more conservative ones, which are the big producers and the big royalty stocks. I mean, of course, I think Franco-Nevada and a Royal Gold are probably the top royalty stocks. However, if we really get that kind of violent gold move, then you probably don't want to own those rather conservative royalty stocks. You want to at least have rather the producers and the Newmont and the Barrick. They have a lot of catch-up potential, and I mean, they have both actually rather a good production profile and a good all-in sustaining costs. However, they have not been able to profit from the gold price over the last 8 months. So they should actually be the first ones to play a violent catch-up once gold breaks out. And then you have the mid and smaller producers. And I can give you a lot of names now, but let's keep it short and sweet here. I mean, I like Minera Alamos from the very smaller ones, where I think we still have to wait probably another few months, because, as I said, initially it's the seniors, then the juniors, then the explorers, and the developers. So Minera Alamos, I like Metalla Royalty, I like Osisko Gold Royalties, I like a very interesting small one from Australia, Barton Gold. I like Marathon Gold, and that's it for now.
Okay, so those are the gold miners you're watching. We are going to get your outlook on digital gold, on Bitcoin next, right after the break. So stay with us.
Begin your path to financial freedom. Gain up to a $7,000 bonus on us. Register and use promo code. Deposit and enjoy a 7% bonus. Available now. Link in the description.